Welcome to this case analysis of SBUX. My name is Nathan Handley, and along with my teammates Alexandria Norman, Sarah Crook, Sudhir Kurup, and Marshall Lucere, we will be analyzing SBUX, which trades on the NASDAQ as SBUX through the lens of our Management 7160 course here at the University of Memphis. I'll kick us off by giving an overview of the company, and I'll keep it brief since everyone likely has some familiarity with SBUX to begin with. It is the world's largest coffee house company, and it holds about 30% of the US market for coffee sales. My teammate Alex will talk more about competitors later in this presentation, but for now, we will just say SBUX is a cut above every other coffee house globally. In fact, it's near the top of the list of food and beverage chains overall, sitting with restaurant giants like McDonald's, KFC, and Subway. The company is headquartered in Seattle, Washington, where it was founded, and it has nearly 41,000 stores around the world as of late 2025. They serve about 100 million customers weekly. SBUX has $37.18 billion in revenue in 2025 and $1.86 billion in net income. Marshall will dig into those numbers in a bit, but suffice it to say, SBUX is very profitable. SBUX is a 55-year-old company founded in Seattle, as we said, in 1971. It was founded as a whole bean coffee seller. It operated that way for about 16 years until 1987, when it was purchased by Howard Schultz. He had visited Italy and was inspired by the cafe and espresso bars, and he had the vision to turn SBUX into a coffee house. 5 years later, in 1992, SBUX had its IPO and began trading as SBUX. Throughout the 2000s and 2010s, SBUX saw rapid expansion and success under Schultz's leadership. It became a global brand, and Schultz became a renowned public-facing CEO. Following the COVID-19 pandemic in 2020, SBUX started to see its brand degrading, and in 2024, they had their first ever CEO change, with Brian Niccol stepping in place of Schultz, and launching his Back to SBUX campaign, seeking to return the brand to the welcoming coffee house image that Schultz had curated in the 1980s and 1990s. SBUX's stated mission is to be the premier purveyor of the finest coffee in the world, inspiring and nurturing the human spirit, one person, one cup, and one neighborhood at a time. Niccol's new Back to SBUX initiative seeks to reorient the massive global company toward being a third space that people can gather outside their homes and offices, aligning with the vision Schultz had in the 1980s after visiting those coffee shops in Italy. Niccol spent time at Procter & Gamble before joining the executive teams at Taco Bell and Chipotle, where he led previous brand turnarounds before taking on this role as CEO, again beginning in 2024. Kathy Smith was brought on in early 2025 to help bring profit discipline to the initiative. She's a 40-year finance veteran and has previously served as CFO at retailers like Target, Walmart, Nordstrom, and GameStop. So these are the primary leaders for SBUX right now. If it wasn't clear from the coffee house label, SBUX's primary product is coffee in all varieties, as well as other beverages. For the last several years, beverages have consistently made up about 73% of SBUX sales. This includes everything from black coffee and lattes, their famous frappuccinos, and seasonal drinks. Another 23% of sales has come from food items, an area where SBUX expanded throughout the 2010s to move from offering pastries and snacks to larger sandwiches and meals. The remaining 4% of sales came from other items, primarily branded cups and mugs, but also tote bags, shirts, and other novelties. As you can see from this overview, SBUX is enormous, profitable, and still the market leader in coffee. However, it arrived in 2024 with real strategic problems for the new CEO to address. Sudhir will take it from here with a pestle analysis.
This slide covers the pestle analysis that we did for SBUX. Now, the reason why we did the pestle analysis is to understand, what the external forces were that shapes the SBUX business. What was the risks and threats? What is their long-term strategy? what kind of new market opportunities were there, and also what kind of laws and regulation they need to comply with. We'll start with P. P stands for political. Now, Starbucks is a global company that operates in more than 80 countries, making it vulnerable to trade policies. Now, trade policies that could affect coffee sourcing or tariffs, labor regulations. Now, there are unionization efforts in the US. The minimum wage increase could actually impact their operating cost and also influence their workforce strategy. Now, political instability. The coffee growing regions like Ethiopia, Colombia, and Guatemala sometimes face political unrest. Now, this can disrupt farming, transportation, and export operations. Now, this can lead to supply shortages or even higher bean prices for Starbucks. Food safety and labeling regulations. Now, whenever there's changes in regulations, there's also compliance cost that gets added to Starbucks. Now, for example, they have to redesign menus, they have redesigned digital boards and mobile app listing ads, and this all adds to operational complexity. The next is E. E stands for economic. There are several factors that would directly affect Starbucks' profit. Inflation. Inflation impacts consumer spending. Now, the higher the prices for essentials, they reduce the discretionary income, leading customers to cut back on premium beverages or even less frequent visits to Starbucks stores. Now, commodity price volatility. Now, if there is rising of increased, or increase in bean prices, dairy cost, and wage increases, that directly raises Starbucks operating expenses and would squeeze their profitable margins. Currency fluctuations across global markets. Now, with major operations for Starbucks in China, Europe, and Latin America, exchange rate swings, fluctuations can reduce reported revenue or and also increase import costs for Starbucks. The last one is the economic downturns. Now, during recessions, customers may switch to lower price competitors like McDonald's or Dunkin' Donuts. They can reduce their frequency of visits to Starbucks store, or they may even choose at home brewing options. The next is S. S stands for social. The growth of specialty culture. Now, this talks about the consumers that has increasingly shifted towards premium, artisanal, and experimental coffee. For Starbucks, this culture shift is beneficial because it reinforces demand for higher margin specialty drinks, and it also supports their brand positioning as a premium coffee house. This also pushes Starbucks to be continuously innovative with new flavors, seasonal beverages, and elevated cafe experience for their customers. Ethical and sustainable consumption trends. This is more for the younger demographics who care deeply about how their products are sourced and the environmental impact of their purchases. For example, fair trade, farmer welfare, carbon footprint, and sustainable packaging. These efforts strengthen brand loyalty, but also increases operational cost and requires long-term supply chain investment for Starbucks. Health conscious preferences. Now, this is more consumers who are slowly shifting towards healthier beverages, plant-based options. They're prioritizing health, wellness, and dietary transparencies on what they buy. Starbucks has had to expand its menu with oat milk, almond milk, coconut milk, sugar-free syrups, and lower calorie drink options for to deal with that. Now, this trend affects product development, pricing, and inventory management, but it also creates opportunity for Starbucks to attract new customer segments such as vegans, lactose intolerant customers, and fitness focused consumers while maintaining relevance in a competitive market. The next is T. T stands for technological. Starbucks innovation and technology change really affects how their market position is. The mobile ordering and loyalty program platforms. Now, this allows customers to place orders ahead of time, reducing their wait times and increasing throughput during peak hours. The loyalty program for Starbucks is called Starbucks Rewards. It actually uses digital engagement to drive repeated purchases through points, personalized offers, and exclusive promotions specific to the user. This technology actually strengthens customer retention and provides Starbucks with rich behavioral data that they can use for AI. Now, AI-driven forecasting and personalization is the other one. Now, yeah, Starbucks can use AI to forecast demands at the store level, predicting inventory needs, staffing requirements and product mixes, based on historical data. It could be, weather patterns or local events or even seasonal trends. Um, this AI also can power personalization in the mobile apps for the user. It can recommend drinks, upsells, and promotions tailored to their preferences. Um, and this AI actually this improves the operational efficiency. It actually reduces waste and increases sales by delivering more relevant offers. Now, the next one is the automation and store operations. This is increasingly used to improve speed, consistency, and labor efficiency. A good example is the automated espresso machines, that can calibrate shots precisely. They're digital menu boards that updates in real time, and kitchen display systems that streamline order flow. The next is L. L stands for legal. Labor laws and union regulations. Now, changes in federal or state labor laws, such as minimum wage hikes, overtime rules, or employee classification standards, directly impact Starbucks operating expenses and also their staffing flexibility. Now, compliance failures can result in legal penalties, lawsuits, or even reputational damage. So that makes labor laws or labor law making labor law adherence a critical strategic priority. Data privacy and digital compliance is another one. Now, Starbucks being a global company, they've got massive amounts of customer data through its mobile app and loyalty programs, which means it must comply with strict regulations like GDPR, CCPA, and many others. Now, they must navigate different privacy standards in each regions because they are all different based on the markets. Um, Now, what this means is that adds a lot of complexity to their digital operations, and they will have to make massive investment in their IT and their cybersecurity, because if the cybersecurity is critical there, because any data breach could lead to financial penalties, customer distrust, and brand damage, especially when Starbucks is much reliant on their digital engagement with their customers. The next one, the intellectual property and franchising rules. Now, Starbucks, being a brand, has to protect its logos, drink names, store designs, and proprietary recipes from imitations, especially in the international market, because the IP, enforcement is pretty low in certain regions. Now, weak IP protection, in some countries can lead to copycat cafes, counterfeit merchandise, or unauthorized use of Starbucks branding, now which all threatens their market share. So, and the other thing is, if when they go into franchising and licensing agreements, it requires Starbucks to comply with the local business laws, their contract regulations and operational standards, which again differs widely across regions. Now that brings to the end of the pestle analysis. Now moving on to the next slide, which is about industry trends. Now, when we analyze industry trends, we found six industry trends that impacts Starbucks. Starting with the first one, premium coffee demand and customization. Now, we've seen that there's continued growth in specialty, cold, and highly customized beverages. Now, this is especially in the younger consumers. The second one is digital and mobile first customer behavior. Now, mobile ordering, digital payments, loyalty programs, and delivery are now becoming baseline expectations. So, digital engagement is essential for customer retention and operational efficiency. The third one, health and sustainability focus. Now, there's rising demand for plant based meals, lower sugar beverages, and cleaner ingredients. And there's a strong consumer preference for ethical sourcing, reusable packaging, and sustainable operations. The fourth one is the intensifying competition. There's always competition from national chains such as Dunkin' Donuts, McDonald's, local cafes, convenience stores, and fast growing international brands. A good example is Luckin Coffee. Now, Starbucks must differentiate through experience, innovation, and digital leadership. The fifth one, AI and operational efficiency. Now, coffee retailers are increasingly using AI, automation, and analytics to improve demand forecasting, personalized marketing, optimizing staffing, and reducing wait times. Now, Starbucks is investing heavily in these technologies to enhance customer experience, streamline store operations, and boost overall productivity. And the last one is global expansion and localization. We have the emerging markets, the Asia Pacific, the Middle East offer major growth opportunities. Now, Starbucks must adapt menus to local tastes to strengthen global relevance. Now, that brings to the end of the industry trends. Now, moving on to the next slide, which is the Porter's Five Forces analysis. Now, for Porter's Forces analysis, it helps evaluate the competitive intensity of an industry. Now, for Starbucks, the analysis shows that while the company has significant competitive advantages, it operates in a highly competitive market with constant pressure from customers, uh, competitors, and substitute products. Let's start with threat of new entrants. The threat of new entrants is moderate. While opening an independent coffee shop requires relatively modest investment, matching Starbucks' global brand recognition, its supply chain, digital ecosystem, and customer loyalty is much more difficult. Now, these factors create significant barriers for companies trying to compete at scale. The next one is the bargaining powers for suppliers. Now, supplier power is also moderate because Starbucks depends on premium Arabica coffee beans that are grown in limited geographic regions. Now, climate change, weather conditions, and supply chain disruptions can reduce availability and increase cost. However, Starbucks helps manage the risk through long-term supplier partnerships and its coffee and farmer equity practices program. Bargaining power of buyers. Buyers have bargaining power because switching costs are low. Now customers can easily choose another coffee shop or make another coffee at home. You know, Starbucks responds by focusing on product quality, personalized service, and its reward program to strengthen customer loyalty. Threat of substitutes. The threat of substitutes are also high. Now customers can choose tea, energy drinks, bottled beverages, convenience store coffee, or even home brewed coffee instead of visiting a Starbucks store. Now, to remain competitive, Starbucks differentiate itself through premium beverages, store experience, and continuous menu innovations. Competitive rivalry. Competitive rivalry is high because Starbucks competes against established brands like Dunkin' Donuts, Dutch Brothers, and Luckin Coffee, along with thousands of other independent coffee shops and fast food restaurants offering specialty beverages. Companies compete through pricing, product innovation, convenience, and customer experience. Overall, Starbucks operates in an industry with high competitive pressure. The company's strongest defense are its globally recognized brand, extensive store network, digital ecosystem, and customer loyalty program, which helps it maintain a competitive advantage despite intense rivalry and numerous substitutes. That brings to the end of the Porter's Five Forces analysis. Now moving on to the next slide, which is the technology development. Now, for technology development, Starbucks has its mobile ordering and loyalty platforms, which enhances convenience and repeated purchase by their consumers. They have the AI investment. Now, for the AI, it improves their customer forecasting, personalization, and staffing efficiency. The automation. Now, the store automation speeds services and improves things consistency. Uh, the next one is the data analytics. Now, with all that AI and data analytics, they optimize their store operations and product decisions that they make for their consumer trend by the regions, by stores. Now, the last one is the sustainability tech, which just actually supports the ethical sourcing and waste reduction for Starbucks. Thank you. Moving on to the next slide.
All right. So for the key events timeline, we'll start with Starbucks' history. Starbucks' history demonstrates how the company evolved from a local coffee retailer in Seattle, in Pike Place Market, into the largest specialty coffee chain globally. So it was founded in 1971, but the biggest turning point came in 1987 when Howard Schultz purchased the company and transformed it into the cafe experience that we recognize today. After its IPO going public in 1992, Starbucks expanded pretty aggressively around the world while also heavily investing in its rewards program and mobile technology, which created one of the strongest customer loyalty ecosystems that exists. It was pretty early into the mobile reward program space, and kind of paved the way for a lot of similar companies like McDonald's and Chick-fil-A. However, like many companies, Starbucks faced significant challenges during the COVID-19 pandemic, and customer behavior shifted towards convenience and digital ordering. In 2024, Brian Nicole became the CEO and he launched the Back to Starbucks strategy, which focuses on faster service, simpler operations, and restoring the customer experience. So far, early financial results suggest that these changes are beginning to gain some traction. For our SWOT analysis, this kind of summarizes Starbucks' current strategic position. Company's greatest strengths right now are its globally recognized brand, its industry-leading loyalty program, digital ecosystem, and over 40,000 stores as of today. They also, however, face some severe internal challenges. Premium pricing can discourage price-sensitive customers. Labor costs and unionization efforts continue to pressure profitability. Looking ahead, there are some significant opportunities to maybe balance this out, though, through some international expansion, AI usage, automation, and continued product innovation, particularly with healthier beverage options. And then at the same time, Starbucks does face some intense from companies like Dunkin', Dutch Bros. Um, there's several other, more local mom and pop kind of places that are also having to compete with Starbucks, and Starbucks is losing some business to them. Um, and then inflation, rising labor costs, and climate change are also continuing to create external risks for the business. All right, for revenue and profitability, Starbucks continues to generate more than $37 billion in annual revenue, which really demonstrates the strength of its brand and its customer base. Revenue has remained pretty stable over the last several years, despite it being a challenging economic environment. However, the profitability tells a different story. Net income has slowly declined significantly, really, as Starbucks has invested heavily in additional labor, store improvements, technology, and operational changes under its turnaround strategy. While some of those investments reduce short-term earnings, management believes they're necessary to improve customer satisfaction and improve long-term growth. So essentially, in other words, Starbucks is intentionally sacrificing some profitability now in hopes of creating a stronger financial reality performance in the future. And then the financial ratios and trends. Financial ratios reinforce the trends we kind of just discussed. Their profit margins have steadily declined as operating costs have increased faster than revenue, reflecting investments in employees and store operations. Return on assets has also decreased, indicating the company is currently generating less profit from its asset base than in previous years. Even so, Starbucks maintains stable liquidity and continues to produce strong operating cash flows, giving it the financial flexibility to execute its turnaround strategy. Overall, the company's financial health remains pretty solid, but investors will be watching closely to see if those investments translate into improved margins and stronger returns over the next several years. So now that we've discussed Starbucks' financial performance and strategic position, I'll hand it over to our next presenter, who will discuss Starbucks' competitive landscape and how the company compares with its largest rivals.
My name is Alexandria Norman, and today I'll be covering Starbucks' competitors, market position, current performance, major strategic issues, and future threats. Here on slide 14, we break down our competitive landscape, which operates on three distinct fronts. First, in the US, speed and drive-thru operators like Dutch Brothers and Dunkin' Donuts are aggressively expanding, capturing customers who prioritize rapid order fulfillment over atmosphere. Second, internationally, particularly in China, digital-first competitors like Luckin Coffee are competing fiercely on price point and mobile ordering convenience. Finally, we face pressure on both ends of the product spectrum. Boutique local coffee shops win on handcrafted quality at the top end, while fast food brands like McDonald's target price-sensitive beverage consumers at the bottom. Understanding this multi-front competition is key to why operational speed and store staffing are central to the strategy. Transitioning to slide 15, let's establish where Starbucks sits in the overall market. As the world's largest specialty coffee chain with over 41,000 stores globally, Starbucks occupies the premium market position. Unlike mass market fast food chains that compete purely on price, the value proposition is built around handcrafted quality, customized beverages, and creating an inviting environment. This unique positioning allows Starbucks to command higher price points and build deep emotional brand loyalty across a wide range of customer segments. Continuing the market position on slide 16, what keeps Starbucks at the top are 4 structural moats. First is the digital flywheel. The mobile rewards platform drives over 60% of U.S. sales and keeps customers coming back. Second is the unmatched real estate portfolio. Third is the vertically integrated supply chain, anchored by ethical sourcing practices that guarantee quality coffee globally. And fourth is the consumer packaged goods alliance with Nestle, which extends the Starbucks brand presence into grocery aisles worldwide. On slide 17, we look at the current performance. In Q2 FY 2026, consolidated revenue surged 9% to $9.5 billion, with global same-store sales up 6.2%. Crucially, in North America, sales grew 7.1%, backed by a 4.3% increase in actual customer visits. This marks 3 consecutive quarters of transaction-led growth, suggesting that back to Starbucks operational fixes, such as better peak hour staffing and faster drink-through output, are winning back consumers. Slide 18 details the major strategic issues facing leadership. How will Starbucks expand their market share and improve throughput without sacrificing premium pricing and store atmosphere? Complex customized drinks create operational friction during peak morning rush hours, while inflation makes some consumers sensitive to menu prices. The core issue isn't demand, it's execution. Streamlining store workflows and managing operating expenses so stores can serve more traffic faster without diluting the brand experience is crucial. Finally, slide 19 outlines future threats to monitor. Externally, drive-thru chains continue opening locations rapidly in suburban markets, and low-cost operators overseas remain aggressive. Internally and operationally, Starbucks faces margin headwinds from elevated green coffee bean prices, wage inflation, and higher store labor investments. To protect long-term growth against these threats, Starbucks must remain disciplined in its execution, continue investing in store-level talent, and leverage its digital loyalty network to maintain customer retention. The photo to the right does not have anything to do with future threats, but it is actually me meeting CEO Brian Niccol. The first time I visited Seattle in 2024, I went and visited the original Starbucks location in Pike Place Market, and he happened to be there, and he was only a month or so into the job, and I figured, what better way to utilize this photo than a presentation on Starbucks? That concludes my section. I am now going to pass it over to my teammate.
This slide looks at the 3 different strategic alternatives we evaluated to address Starbucks' major strategic issues. We looked at 3 possible paths: diversification through M&A of a beverage company, international expansion, which is the growth option, and a pricing option in adding value items to the menu. Diversification offers portfolio growth but carries high risk, and it doesn't do anything to address improving speed or customer experience, which are the main challenges they're trying to improve. International expansion has long-term potential, especially with joint ventures in markets like China, but it also brings high political, regulatory, and competitive risks. It would also reduce any resources the U.S. needs for its turnaround strategy. It remains a viable option, but not right now. Value items addresses some of our economic concerns of having less disposable income due to rising inflation. But it also creates some problems as well by diluting the premium brand and compressing margins, to the point where it would be too close to Dunkin' and end up in a price war. Overall, each alternative has strengths, but none of them directly solve the core issues of restoring traffic while maintaining profitable growth. We developed a decision matrix to objectively decide which alternative matched Starbucks' requirements. We weighted criteria based on what matters most to Starbucks right now. Brand and consumer experience at 30%, strategic fit at 25%, financial impact at 20%, and risk, which is implementation risk, at 15%, while long-term growth came in at 10%. International expansion scored highest on the matrix, but still not enough to outperform the current strategy. Value items scored moderately, but introduced brand and margin concerns. And M&A scored lowest due to poor strategic fit and highest integration risks. Based on the matrix, none of the alternatives outperformed Starbucks' existing strategy, which is back to Starbucks. It scored a 4.25. So, our recommendation is to continue the Back to Starbucks turnaround strategy, but strengthen it with the targeted improvements listed in the roadmap on the next slide. Our implementation roadmap consists of 4 different phases. Instead of creating a brand new map, we suggest they strengthen the current one by adding targeted improvements. This can enhance the Back to Starbucks strategy over time. Immediately, they can focus on strengthening the Green Apron service model that is the foundation of the community and experience. These are things like warm greetings upon entering, handwritten names on cups, offering real mugs and glassware when staying in the cafe. The goal is to return to the human connection it had created in its third place, a warm, welcoming environment that entices customers to relax for a minute. They can also begin regional pacing to avoid overwhelming stores during rollout. Finally, they can use the early results from the last 18 months plan as a pilot data before scaling. In the short-term phase, Starbucks can expand limited edition merch and collectibles. The little guy over to the left of your screen is Barista. It was introduced last year as a cold cup. It went viral and sold out within hours of the release. It has proved this can drive meaningful incremental revenue and traffic when it drove 64 million. Strengthening the digital flywheel is responsible for driving 60% of the U.S. revenue, and introducing rewards early access drops can increase loyalty and remain good options as well. For midterm phases, Starbucks can focus on rollout store refreshes, which are like mini remodels that improve flow and experience without full renovation costs. Nickel explained each store would receive about $150,000 for these, which mostly are restoring seats that were previously removed, as well as improving the design. Improving staffing models using AI forecasting through Deep Brew can also be addressed in midterm or long-term planning. And finally, the remaining phase includes reevaluating international growth opportunities, including joint ventures in markets like China, continuing expanding the digital ecosystem and its features, and reinforcing the global brand consistency while keeping in mind the back-to-human connection aspect. The risk and mitigation slide outlines some of the operational risks that could arise when continuing to implement the current strategy and the mitigation strategies to alleviate them. Margin pressure remains a risk. As you'll remember, although revenue was relatively stable, net profit margins dropped significantly from 11% to 5%. They can mitigate this by prioritizing high traffic, high ROI stores first. Competitors may continue attracting price-conscious customers. Targeted limited-time offers can help retain them without having to offer discounts. Back to Starbucks shows promise, but it might not scale evenly. it's important to treat early results as pilot data and allow or even expect adjustments before full rollout. Labor costs may continue to rise, but AI and mobile ordering can help offset the cost by improving speed and efficiency with forecasting. Operational overwhelm is possible, but regional rollout with feedback and review reduces this risk. In conclusion, Starbucks was not failing, but it did drift far away from its core business model, the third place, and the premium customer experience. This was its primary source of differentiation and competitive advantage. As the experience was weakened, traffic declined and profitability was eroded. Starbucks' core challenge is restoring profitable growth while improving customer experience. Nichols' turnaround strategy, back to Starbucks, focused on restoring the brand to its original strengths. As mentioned earlier in the presentation, early performance indicators show his strategy is gaining traction. We evaluated 3 strategic alternatives against the current strategy, but none of them outperformed the current strategy. Our analysis shows that continuing back to Starbucks is the strongest strategic path. However, with targeted improvements, like expanding collectibles, strengthening the digital flywheel, pacing rollout, and refining pilot data. These can all enhance the current strategy without changing its direction to help Starbucks improve customer experience and traffic and support long-term profitable growth. This concludes the case analysis of Starbucks. Thank you.